Benjamin Franklin once said, "In this world, nothing is certain except death and taxes." This shows how important and scary taxes are. No matter if you are a boss or an employee, taxes are something you can hardly escape. You can think back. How much tax did you pay in the past year? What is your actual tax rate? I believe every taxpayer who is watching this video has a deep feeling. However, a media called ProPublica dropped a bombshell. It exposed the tax situation of the 25 richest people in America. And you will find that they didn't pay much tax. For example, Buffett, who often claims that the rich should pay more taxes. But according to this exposure, he only paid $23.7 million in taxes from 2014 to 2018. $23.7 million, a very large number. But compared with his wealth growth of $24.3 billion in these 5 years, it only accounts for 0.1%. The same formula. Let's take a look at the former world's richest man, Jeff Bezos. His tax rate is 0.98%, not even 1%. On the other hand, we work hard every day, but have to pay 20% to 40% of taxes. Don't you feel very upset? So, today we are going to explore the tax avoidance methods of these top tycoons. Of course, we do not discuss illegal operations such as tax evasion. We also put aside the moral and subjective aspects. Just from the technical perspective of legal and reasonable tax avoidance, let's see how they operate. First of all, simply speaking, tax is the government taking a certain percentage of your profit. Of course, the actual situation is very complicated, and the tax law itself is very headache-inducing. To sum up, the taxes related to our income and profit are mainly divided into 3 categories. The first category is direct income, which is very easy to understand. I am a teacher. I receive salary. I go to work in a restaurant, receive salary. I rent out my house, earn rent, and so on. We have to pay income tax for this part, which is also the most familiar tax type for us. As long as you have a job, you basically have to pay, and the tax rate can reach almost 50%. The second category is called capital gains tax, such as buying a house, investing in stocks, buying artworks, etc. The thing you buy appreciates, and you have to pay a certain percentage of tax for the appreciation part. In Europe, this tax rate can generally reach 20% to 30%. The third category is called inheritance tax, or money that you get without working, and the government will also take a certain percentage from it. In some countries, the inheritance tax rate is astonishingly high. Okay, income tax, capital gains tax, and inheritance tax are all briefly introduced. Next, let's talk about how these top tycoons operate. First of all, income tax, how to calculate it. It is your income multiplied by its tax rate. The income part specifically refers to the income you need to pay tax minus the deductible costs, then put it in brackets and multiply it by the tax rate. So if you want to avoid tax, you just need to start from these 3 indicators, and the most direct one is to reduce taxable income. You see, most rich people have their own companies and have control over them. So they can tell the board of directors not to pay them very high salaries. A high salary spread out will make them controversial. They only need to pay them a little bit, just a token, such as $1 salary. This way, they can not only establish a noble and selfless image to the outside world, but also reduce their taxable income. Let's analyze what their real purpose is for doing this. Think about it. These people who earn $1 salary are all people who hold huge shares. For example, suppose there is a rich man who holds 10 billion shares of a company. If the stock rises by 1%, it means a wealth increase of 100 million for him. If he receives tens of millions of high salaries every year, it will have a negative impact on his image and reputation. Then, it will affect his company's stock price. If affected by this, the stock price drops by 1%, it means a loss of 100 million for him. And in reality, the negative news of the head of a listed company often causes the stock price to fall by more than 1%. By comparison, tens of millions of salaries don't seem to be that tempting. You can imagine why they are willing to accept $1 salary. In fact, since the early 20th century, the United States has seen a trend of earning $1 salary, $1-a-year man. Now, many top rich people and tech giants, even if they are not earning $1 salary, the salary they receive is actually very low. Then you may be puzzled, how do they maintain their daily living expenses with such a low salary? The answer lies in this formula. We continue to observe this formula. We have just finished talking about reducing taxable income, and the next step is to increase deductible costs. How to understand this? For most of us, many of our living expenses are paid with our after-tax wages. For example, you earn $10,000 in salary, and after paying 20% tax, you have $8,000 left. Then you buy a laptop for $5,000, and you have $3,000 left. But the rich don't do that. Don't they all have their own companies? So, for the same laptop of $5,000, the laptop can be purchased in the name of the company's office use. Then this $5,000 can be deducted as a cost before tax. In this way, it becomes $10,000 of income, minus $5,000 of cost, and then the remaining part is taxed. At this time, there are $4,000 left, which saves $1,000 more than people without a company. Similarly, they can use various accounting methods. As long as the expenses related to the company's operation, they try to use them as costs to deduct taxes. The rich try to be quiet and hide their ears when they make money, but they are flamboyant when they spend money and try to deduct all the expenses. After calculating, the part that needs to be taxed is drastically reduced. For example, in the report of ProPublica, Jeff Bezos had a dividend of $46 million in 2007, but after various deductions, the tax he paid was very little. Of course, not all expenses can be used for deduction. First, you have to have a company. Second, these expenses have to be reasonably related to the company's operation. Speaking of this, it is very interesting. For most of us, it is actually quite difficult to relate our personal daily expenses to the company's operation and business. Our daily expenses such as eating, refueling, paying rent, paying utilities, etc., have little to do with the company's operation. But the tycoons are different. 99% of their expenses can actually be related to the company's operation and business. Travel, banquet, and other expenses are naturally needless to say. Even the cost of clothing and makeup can be used for deduction. Because clothing and makeup determine their public image, and the public image of the company's top figures is of course closely related to the company's development. Then, these expenses naturally go into the company's accounts as costs or expenses for deduction. Speaking of this, I remember that when Donald Trump was investigated for tax, according to the New York Times report, his annual hairstyle fee was $70,000. In addition, Zuckerberg started to receive a $1 salary from 2013, but his family's private jet consumption, security amount, and other expenses reached $23.4 million in 2019. Does it sound shocking? But what I just said are actually just routine operations. Next, let's take a look at the advanced operation, charity. I think most people should have heard that charity can be tax deductible. For example, if you donate a tent this year, the value of this tent may not be high, but when you file your tax, you can still put it into the deduction project. Of course, the tycoons are generous when they do charity, often hundreds of millions of dollars. Then, these charitable donations can be used as deduction items. For example, a tycoon earned $500 million this year, and he donated $100 million to charity. Then, the part he needs to pay tax is the remaining $400 million. Of course, we are not maliciously guessing the purpose behind these charitable acts is to avoid taxes. We are just simply exploring the operating space of charity in the tax level. In fact, most of the tycoons' charitable donations are really for supporting charitable causes. For example, the Bill and Melinda Gates Foundation, which Bill Gates and Buffett jointly participated in, has done a lot of praiseworthy things over the years. However, there are still some charitable foundations that use the name of charity, but actually do some things for their own benefit. For example, I think many people should know GoPro, which is the wearable shooting device. Its founder, Nick Woodman, immediately donated $500 million to a foundation after GoPro went public in 2014. This is, of course, a very generous charitable feat. The Chronicle of Philanthropy named Mr. Woodman one of America's most generous donors that year, placing him alongside established philanthropists like Bill and Melinda Gates and Michael R. Bloomberg. In donating allowed to avoid paying capital gains tax on his $500 million worth of stock, likely saving him tens of millions of dollars per Forbes estimate. But if you keep track, you will find that the $500 million have not been spent until now. Nick Woodman donated the money to a foundation called Silicon Valley Community Foundation, which has a big background. Many of the tech upstarts in Silicon Valley are involved, such as Facebook's Mark Zuckerberg, Netflix's Reed Hastings, Twitter's Jack Dorsey, Google's Sergey Brin, WhatsApp's Jan Koum and Brian Acton, and Microsoft's Paul Allen. The foundation manages a total of more than $13 billion in assets, but its nature is very different from the open and transparent foundation of Bill Gates. It is called donor-advised funds, or DFs, meaning that the donors can decide whether and how to spend their donations, which is not required to disclose details about how, if at all, individual donors spend their charitable dollars. Mr. Woodman, GoPro, and Silicon Valley Community Foundation all declined to discuss the Woodman Foundation's situation. There are a lot of things that can be done here. For example, I have a child who is in school. I can donate money to his school or the school he is going to apply for. Or if I like golf, I can donate money to my favorite golf club, and then I can go there to consume. In this way, the tycoons can not only pay less taxes by donating money to donor-advised funds, but also control the funds for personal consumption. If the benefit to the needy is difficult to see, the benefit to Mr. Woodman is clear. After GoPro's initial public offering, he faced an enormous tax bill in 2014. But by donating via the Silicon Valley Community Foundation, he eased his tax burden in two ways. First, Mr. Woodman avoided paying capital gains taxes on that $500 million worth of stock, a figure that most likely would have been in the tens of millions of dollars. He was also able to claim a charitable deduction that most likely saved millions of dollars more and probably reduced his personal tax bill for years to come. Unlike family foundations, which are required to distribute 5% of their assets each year and have historically been the way wealthy donors disperse their philanthropic firepower, DFs have no distribution requirements, meaning that billions of dollars earmarked for charity can sit idle for decades. And because organizations that manage DFs are not required to report which funds give money to which causes, it is impossible to know how much money individual donors are giving away to nonprofit organizations. In addition to donating cash and stocks to foundations to achieve tax benefits, you can also donate artworks to foundations to pay less taxes. For example, you bought an artwork for $1 million, and a few years later this artwork rose to $10 million. If you donate it to a foundation at this time, you can get a tax deduction of $10 million. And for artworks, which are assets with very poor liquidity, how much is their market value? How to determine their donation amount? Usually by professional appraisal agencies to evaluate, then there are a lot of operating space here. In this way, you can avoid the high commission generated by the auction and pay less capital gains tax. Currently, the capital gains tax on artwork is 31.8% rather than the current maximum for the sale of real estate, stocks and bonds, which is 23.8%. The non-tax costs of selling art can also be daunting. There is the seller's commission, as high as 25%, plus state capital gains tax as well. This means that sale at auction could result in half of the hammer price going to taxes and fees. All right, we have finished talking about how to reduce income and increase deductible costs. Next, we will talk about tax rates. Obviously, the lower the tax rate, the better. So how do we do that? Simply put, it is to adjust our income from a high tax rate category to a low tax rate category. Taking the United States as an example, after Trump took office, he lowered the corporate tax from 35% to 21%. Suppose you are a high-income earner, because your personal income is very high, so your applicable personal income tax rate is about 40%. What if these incomes are not counted as personal, but as corporate income? Obviously, the tax rate drops from about 40% to 21%, and you save 20% of taxes. This is also why sometimes we find some companies that seem to be empty shells. They have no business, they only have a few people, or even one person. In addition, where the company is located is also very important, as the tax rates in different regions are different. Like the well-known Cayman Islands, Bermuda, British Virgin Islands, these areas have very low tax rates. Take the Cayman Islands as an example, it does not levy corporate tax, which attracts nearly 150,000 companies to register here, while its population is only about 70,000. Now we have finished talking about how to reduce income, increase deductible costs, and lower tax rates. These methods are all used to avoid income tax. However, the taxes that are avoided by using these means are just the tip of the iceberg for the rich. Their wealth accumulation and growth mainly rely on the increase in the market value and stock price of the company. For example, Elon Musk, his wealth increased by $140 billion in 2020, which mainly benefited from the soaring stock price of Tesla he held. In front of $140 billion, tens of millions of dollars in salary income seem to be insignificant. This asset appreciation brought about by the rise in stock prices belongs to the second category we mentioned before, capital gains tax. Generally speaking, when you sell stocks and realize profits, you need to pay capital gains tax. If you hold stocks without cashing out, no matter how high the stock price rises, you do not need to pay capital gains tax, and you can also maintain control of the holding company. Then some people will have doubts. No matter how high the stock price rises, as long as you don't sell it and cash out, it is just a paper value, and you can't use it for consumption directly. You have to cash out this paper value sooner or later, and you still have to pay taxes at that time. However, the fact is not the case, which has to talk about another very important operation of the rich to avoid taxes, using stocks as collateral to borrow money. For example, imagine I am Zuckerberg, okay? At this time, I go to a bank and say, "Hey, look, I am Zuckerberg. You know how wealthy I am, right? My stock is worth $100 billion. Lately, I'm a bit short on cash. Can you lend me some money? I can use my stock as collateral." Think about it. Zuckerberg holds a lot of Facebook stock. His credit is far superior to ordinary small and medium-sized enterprises, and he also has stock as collateral. He can borrow money with ease, and the interest rate is very low. For these top-notch rich people, their net worth is too high, so their daily expenses, no matter what, are a drop in the bucket. As long as their company's stock price does not crash, they can always borrow money from the bank like this. Always use the stock as collateral and keep borrowing money. Now, some buddies will ask, what if the stock crashes? If the stock crashes, then they will not worry about tax evasion anymore. So, you see, in this way, they don't have to sell the stock, they don't have to pay taxes, they can get the money, and life is still very good. Isn't it awesome? For example, Elon Musk used Tesla's stock as collateral in 2020 and borrowed $350 million and $500 million from banks twice. In this way, he can maintain control of Tesla and use the loans to consume or invest without paying capital gains tax. Then some buddies will ask, don't they have to pay back the money they borrowed? No matter whether they invest in stocks, real estate, or art, no matter how much they compound their interest, there is always a limit, and one day they have to sell the stock and cash out. However, for the rich, it's not like that. This brings us to the third part we are going to talk about, which is wealth inheritance. These rich people, their wealth is constantly accumulating, and they also go to mortgage and borrow money. Their debt is also constantly increasing. They just do it step by step, building their own business empire. One day, they will pass their wealth to the next generation. We just said that only death and taxes are inevitable and inheritance. Well, that's the beginning of the whole cycle we just talked about. We take the United States as an example. When the money is passed to their children, the part of the unrealized asset appreciation is tax-free. But then, the children have to pay an inheritance tax. We all know that inheritance tax is very high. In many countries, it can reach 50%. Then the question arises, do you think these rich people are stupid? They worked hard for a lifetime, and in the end, they have to pay half of the tax. The answer is obviously no, because there are actually many ways to avoid these inheritance taxes. For example, irrevocable trust. The rich put the money into a trust, pass it to their children, not only avoid the tax, but also they can add some additional terms. Or you can set up a family charitable foundation, then you put the money in, and all the taxes we just talked about are exempted. And also, these foundations, their investment income does not have to pay taxes. This way, you can directly pass the foundation to your children. Well, you see, after the series of operations we just talked about, the rich have formed a perfect closed loop for their wealth. When your wealth accumulates to a certain scale, you can hire professional tax and accounting experts to help you do a long-term tax planning, such as reducing wages, tax relief, lowering tax rates, loans, etc. A series of operations can ensure that wealth continues to accumulate and money can still be spent. After that, pass it to the next generation. Of course, we don't judge these moral issues. Just look at these operations. I have to say, the gameplay is really amazing.